Hi YouTube, James Baker CPA here, and today I have a fun video for you. I'm going to teach you about Form 706NA. We're going to go over, how to complete it and who actually has to file it. So Form 706NA is titled the United States Estate and Generation Skipping Transfer Tax Return, Estate of Non-Resident, Not a Citizen of the United States. And I'm going to show you the form in a second. I'm going to share my screen, but this form is required when you are a non-resident and you die and you have U.S. assets in your name and your family is trying to get a hold of those assets per your estate, per your will, and you need to pay estate taxes on these assets. And I've made other videos. I'm making a series of videos about this. But in the other videos, I basically talk about the most common situations is when a foreign person, and we say a non-U.S. resident, a non-U.S. citizen, owns U.S. real estate or a U.S. brokerage account with U.S. corporate stock in it. And the estate tax has an exemption of $60,000. The way we calculate it is quite complicated. You have to do it manually, and yet you're subject to tax on the fair market value of these assets as of the date of death, and it's a 40% tax, up to 40%. It's graduated progressive rates, but it gets up to 40%, and it's a very cumbersome thing. Until you file this form and show that you paid your estate taxes, the title companies and the brokerages won't release title or access to the assets that you are due to inherit. So it's super important to file this form correctly and to file it on time. If you don't file it correctly, you could be greatly overpaying taxes. And I'm going to go to one example that I just prepared for a client. I deleted all the names and everything, of course. But I'm going to go to one example here and show you some of the numbers and how I did it and how to prepare the form. The 706NA is the ultimate form. When I prepare it, I add other statements, other schedules, other attachments. But I'm going to go through the form and just to give you an idea of how it's to be prepared. Okay, so let me pop out my screen here. Great, so here I am. So you can see right here, this is Form 706NA, the United States Estate Tax Return, Estate of Non-Resident, Not a Citizen of the United States. So this is to be filed for decedents dying after December 31st, 2011. It's a generic form. You have to put the date of death on here. This is all basic info. So the decedent is the person who died, their first name, their family name. If they have a tax ID, you put it in there. Many don't. But if you have stock from a job you worked in the U.S., you probably do. Place of death, domicile, date of death, and citizenship, nationality. This is important because there's, I believe, 13 countries that have death tax treaties with the U.S., and that greatly reduces the amount of estate taxes that would be calculated because generally the exemption is $60,000. And this is the, and I don't want to go through, I'll go through the lines later because this is the end of the calculation. The calculation starts over here, down here at the bottom, and it finishes up here. So I'm going to go through that. So let's go line by line through this a little bit. I'm going to go through it quickly because it's quite complicated and it's also quite nuanced, right? The beginning is easy. Like this is all place of birth, date of birth, name of the executor. That's generally the person who's hired you to do this, or if you're doing it, it's generally you. The executors generally hire me to do this for them. Name of the attorney for the estate, the address, all that stuff. This we're going to go to next. Down here is where you sign. This is one of the few forms that can be signed electronically and submitted to the IRS. And, if you want the IRS to talk to your preparer, you check that box. When I prepare these, I put my name on here as a representative, and I'm a certified public accountant, so I can actually directly talk to the IRS. So this is pretty cool. It makes it a little easier for me to get the information for my clients, and this is a new version of the form that came out in 2019. And then they ask a bunch of questions. Did the decedent die testate? That means, did they have a will? In this example, yes, they did. Were there letters or administrative testamentary letters granted? No, because they had a will. Did they own any real property in the United States? That's real estate. And then U.S. corporate stock would be, yes, this person owned corporate stock. Did they have debt obligations? Did they have a U.S. trade or business at the date of death? Did they have access to a safe deposit box? Was there jointly owned property? And this is very common when there's real estate. and it's in the right of survivorship. And there's a couple of different ways we can prepare it. And I've successfully saved my clients a lot of money by doing this the right way. Lots of money, like hundreds of thousands of dollars. And it's really great feeling when you can help someone who's grieving get through this. Has the decedent been a citizen in the past? You know, were they in the last 10 years? Did they make a transfer at the time of death? And generally on all of these forms, we're only going to report the assets that are in question. So in this example, there was a brokerage account. I had the description there, but there was a brokerage account with $200,000 of U.S. stock in it. And that's the only asset we're really going to mention here. Only the U.S. assets are subject to estate taxes. So if they gave any other gifts outside of the context of this, then yeah, that would be like technically, if you give empty your stock account and distribute it out after you die, you have these would be yes, you have estate taxes. But this is something that's really crazy. This form is not really like the IRS isn't pursuing too heavily this form. It's more of the gatekeepers, it's more of the brokerage accounts and the title companies that are pushing I'm gonna leave it like that are pushing the clients to do this, because if they don't file this and they don't get the tax clearance certificate, which I'm going to go over in a separate video, they can't get the funds. So in this, the stock was worth $204,000. That's the only this is the gross estate in the United States right down here. With the gross estate outside the US, 2.6. The entire estate, it's math right there. We have the funeral expenses, and you can deduct a proportion of this funeral expenses and debts and liens, or you can deduct a proportionate amount of this. There's a calculation that goes into there. It has to be done. I have a separate work paper for it. And then this is the taxable estate. It's basically the 204 minus the 2177. I did all this even though this is subject to under a tax treaty, and I'll go over that next. Maybe I'll make a separate video. Already it's 7 minutes. So from this taxable estate 201, we put it up here, taxable estate from Schedule B, line 9. This is the gifts located in the U.S. Blah blah blah. It's almost always zero for me. Tentative tax on line 3, tentative tax on line 2, and then the gross estate tax. And this is line 5. Subtract line 5 from line 4. Well, I guess I should have put. Whatever, the gross estate tax is $55,000 on this, and we have to go to the instructions for Form 706, the actual, and maybe I'll pull that open. I'll show you that. You calculate the tax on Form 706, the instructions for it, which are not here. I didn't download those. Whatever. You can Google search Form 706 to calculate the tax. And then if you have a treaty, which we're claiming here, we're claiming Australia-U.S. Tax Treaty, Article 4. This is the code section. It's overruling. These are my explanation for doing it. And it's under 6114. And then we put all the information up here. So when you're attaching that with all the details, that allows us to use the full unified credit against this. Generally, this is subject to like around 13,000. Is the credit. So if this person was not from Australia or a country with a death tax treaty with the U.S., they would have had to pay a 13,000. Yeah, like a $40,000 tax, $41,000 of taxes before receiving this $200,000 just because it was in the U.S. Luckily, this person was from Australia and a citizen of Australia, so we could use the death tax treaty. But if they weren't, they would have been paying a $40,000 tax. That's why this is so important. So if you're watching this and you already haven't had a relative that's already passed, then, let's talk and let's fix it. If you are watching this because you need to fill out this form for a relative, while you have to pay a professional like me to do it, I don't do this for free. I'm obviously working out here. I give the information for free. You can watch this and do it. I'm finding in my experience that all of the returns I work on, I find a way to lower the tax significantly, greatly covering my fees. So I would be happy to have a talk with you and review some of this with you and actually prepare it with you and do this for you. So you can contact us in the description below. I'm happy to help. If you thought this video was helpful, like, subscribe. I'm making more. And check out my channel because I have a lot more videos about this topic on the channel. So I hope this was useful. It's another how-to video, and I will see you guys later. I appreciate you being here supporting the channel.